Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Advanced Drainage Systems, Inc. quarterly report. Advanced Drainage Systems, Inc. provides a wide range of businesses and services related to water management products. The company's offerings include thermoplastic corrugated pipes, plastic leach-filled chambers, EZ-Flow synthetic aggregate bundles, and wastewater purification systems for residential and commercial use. The company also offers septic tanks and accessories, combined treatment and dispersal systems, and allied products such as storm retention/detention and septic chambers. Additionally, Advanced Drainage Systems provides PVC hubs, rubber sleeves, and stainless steel bands for various applications. Furthermore, the company purchases and distributes construction fabrics and geosynthetic products for soil stabilization, reinforcement, filtration, separation, erosion control, and subsurface drainage. Its product line also includes drainage grates and other related products. The company's services cater to non-residential, residential, agriculture, and infrastructure applications through a network of distribution centers across the United States, Canada, and internationally. The significant increase in Advanced Drainage Systems, Inc.'s ADS stock price over the past year can be attributed to several key factors. Firstly, the company's strong fiscal Q3 2026 earnings and increased stock repurchase authorization were major catalysts for the stock's upward trajectory. The robust financial results, which exceeded analyst estimates, were accompanied by a new $1 billion stock repurchase authorization, bringing the total buyback capacity to $1.148 billion. In addition to these positive earnings surprises, ADS made a strategic move with the acquisition of National Diversified Sales, NDS, in September 2025. This approximately $1 billion all-cash deal is expected to enhance the company's water management offerings and strengthen its market position as a comprehensive water solutions provider. Furthermore, ADS reported solid fiscal Q2 and CONE 2026 results, with nearly 9% and near 2% increases in sales respectively. These performances were accompanied by analyst upgrades and raised price targets from firms such as RBC Capital, KeyBank, UBS Group, and Oppenheimer. The collective impact of these events has driven investor confidence and contributed to the stock's significant increase over the past year, with a one-year change of 35.97% and a 52-week high of $161.19. Advanced Drainage Systems, Inc. market capitalization of $13 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Advanced Drainage Systems, Inc. holds a significant advantage in their industry. Advanced Drainage Systems, Inc. trades at a higher price-to-earnings ratio of 28 times and a higher price-to-book ratio of 6.86 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 56% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through an analysis of the extracted summaries. On one hand, the Infiltrator segment has been a significant contributor to revenue growth, with a 16% increase in 9 months ended December. Additionally, the Allied Products and Other segment has also seen growth, with a 9% increase for 3 months ended December and a 7.3% increase for 9 months ended December. Domestic sales have been a key driver of revenue growth, with domestic Allied Products and Other sales increasing by 9.4%. Infiltrator sales have also seen significant growth, increasing by $70 million, 15.9%, to $511 million. On the other hand, there are areas where revenue has declined. The international segment has seen a decline in revenue, with an 8.5% decrease from 2024 to 2025. Pipe segment revenue has also decreased, with a 3.1% decrease for 3 months ended December, and a 2.6% increase for 9 months ended December. Domestic pipe sales have decreased by 3.8%, while international sales have decreased by $8.4 million, 5.1%, to $156.2 million. Overall, the analysis suggests that revenue growth is driven primarily by domestic sales of allied products and other and infiltrator segments, while revenue decline is attributed to the international segment and pipe segment. The net income of a company has shown an increase in both quarterly and year-to-date results. In Q3 2025, the net income rose by $11,748, 14.3%, to $94,037,000 compared to Q3 2024. Similarly, in YTD 2025, it increased by $20,613, 5.5%, to $394,628,000 compared to YTD 2024. The profit margins have also seen an improvement. The gross profit margin has risen from 35% to 37.4% in Q3 2025, and from 38.1% to 39.2% in YTD 2025. Additionally, the operating income margin has increased from 18.3% to 19.7% in Q3 2025, and from 23.6% to 23.9% in YTD 2025. These changes indicate a positive trend for the company's financial performance. However, the reasons behind these improvements are not explicitly stated in the provided information. The company is indeed generating positive operating cash flow. This can be seen in the net cash provided by operating activities and free cash flow figures for both 2025 and 2024. For 2025, the net cash provided by operating activities stands at $779,133, indicating a significant increase from the previous year. Similarly, the free cash flow figure for 2025 is estimated to be around $774.9 million, also showing an upward trend. In comparison, the figures for 2024 show that the company was still generating positive operating cash flow, with net cash provided by operating activities at $540,264 and free cash flow of approximately $712.5 million. These numbers demonstrate a consistent ability to generate cash from operations over the past 2 years. The company's debt level has remained relatively stable over the past year. While there have been some minor fluctuations, the overall trend shows no significant change. Total liabilities increased slightly from $2,054,572 to $2,115,294, but this is a small increase of only about 3%. Additionally, long-term debt decreased by $18 million, which suggests that the company has made efforts to reduce its debt burden. On the other hand, interest expenses have decreased slightly. The company's interest expense dropped from $23,094 in 2024 to $22,579 in 2025, a decrease of about 2%. This reduction in interest expenses is a positive sign for the company, indicating that it has managed its debt effectively and reduced its financial burden. Overall, while there have been some minor changes in the company's debt level, the overall trend suggests stability. The slight decrease in interest expenses is also a welcome development, suggesting that the company is managing its finances efficiently. Management is optimistic about the company's outlook, citing favorable weather conditions as a key driver of sales growth in the first 2 quarters of the year. The growth in core non-residential and residential construction end markets has also contributed to domestic net sales. However, management notes that there are some challenges ahead, particularly with regards to integration costs associated with recent acquisitions. Despite these challenges, management is confident in the company's ability to meet its working capital requirements for at least the next 12 months, thanks to a strong cash position and available financing arrangements. Overall, the outlook suggests that the company will continue to experience growth in certain markets, but may face headwinds in others due to decreased demand. management is aware of the potential risks associated with integration, including significant costs and diversion of management attention. However, they are also optimistic about the long-term benefits of these acquisitions, which are expected to drive future growth and profitability. The company has made several strategic moves through acquisitions and divestitures in the recent period. In terms of acquisitions, the company has purchased National Diversified Sales, NDS, and River Valley Pipe, with a preliminary purchase price of $3 million for the latter. Additionally, Orenco was acquired in the prior year. In contrast, the company has also engaged in divestitures by selling properties held for sale. These transactions demonstrate the company's efforts to expand its operations through strategic acquisitions while also optimizing its portfolio by disposing of non-core assets. The company has demonstrated its commitment to returning value to shareholders through various means. One such method is the payment of dividends. As per the provided information, the company has indeed paid dividends in the form of a quarterly cash dividend of $0.18 per share. In addition to paying dividends, the company has also engaged in share buybacks. This strategy allows the company to reduce its outstanding shares and potentially boost earnings per share for existing shareholders. The company's share repurchase program has an available capacity of $1.1 billion, indicating a significant commitment to buying back shares. Furthermore, the company has already executed a repurchase of common stock in 2024 for -$69,922, demonstrating its active participation in this strategy. Overall, these actions suggest that the company is actively working to return value to its shareholders through both dividend payments and share buybacks. Concerns about inventory buildup and supply chain disruption are evident in the recent data. Inventory levels have increased significantly, with raw materials rising by $8,359,000 and finished goods increasing by $48,665,000 from December 31, 2024 to March 31, 2025. This surge in inventory is also reflected in the company's working capital, which has grown from $926.4 million to $1,291.7 million due to changes in inventory. Furthermore, fluctuations in raw material prices and availability have been a concern, as well as disruptions caused by general business, political, and economic conditions. The accelerated depreciation of assets and restructuring liability also indicate potential supply chain issues. Additionally, domestic pipe sales have decreased by $12.9 million, or 3.8%, to $326.7 million, which may be a sign of supply chain disruption affecting the company's operations. That concludes the financial summary for Advanced Drainage Systems, Inc. Feel free to comment below, and I will be happy to answer them when possible.